Welcome to the Deep Dive. Today, it's episode 47, and we've got a really interesting one lined up, especially for Max from Duluth, Minnesota.
Yeah, Max sent in a great question. It's about something a lot of people are wondering about these days, cryptocurrency and how it fits into retirement savings.
Exactly, and it ties in perfectly with this season of the Deep Dive. We're calling it the Retirement Blueprint, mastering IRAs, 401ks, and more. So, crypto.
Yeah, that definitely adds a layer of complexity, doesn't it?
It absolutely does. And, before we really jump in, we should mention that this whole deep dive conversation was produced with input from Katie St. Ors. She's a certified financial planner, a tax strategist. Her insights were super helpful here.
Definitely need that expert eye on this topic.
Yeah.
Because let's face it, crypto is, well, it's exciting, there's potential there, sure, but also makes people nervous, especially when you start talking about nesting it alongside your serious retirement money. That's the heart of it, isn't it? Can this, volatile digital world actually play nice with the more traditional, often conservative world of retirement plans?
So let's tackle Max's big question head on, the one probably on a lot of minds. Can you actually stick cryptocurrency directly into your 401k, like right alongside your mutual fund?
Okay, so the quick answer, generally no. Not directly, not in the way you'd normally buy stocks or funds in your company's 401k. That direct path, it's mostly blocked right now.
Blocked. Okay, why? What's the main roadblock stopping someone from, say, adding Bitcoin to their 401k portfolio?
Well, a big piece is the regulatory scrutiny. You've got the IRS, sure, but especially the Department of Labor, the DOL, they have some pretty serious reservations about letting crypto into these plans.
I remember hearing about the DOL weighing in on this pretty strongly. What are their specific worries? What's making them so cautious?
Their main job is protecting retirement savers, right? So they're worried about cryptos, wild price swings, the potential for fraud, and just how hard it can be to pin down a reliable value. Back in 2022, they put out guidance basically telling plan fiduciaries,
The people managing the 401k plans.
exactly, telling them to use extreme care if they even thought about offering crypto options.
Extreme care. Wow. Okay, that sounds like more than just a gentle warning.
Yeah.
What specific risks did they flag?
They pointed to a few key things. The extreme volatility, obviously. The difficulty in actually valuing these things consistently. Big cybersecurity risks too, hacking and theft, and just the overall speculative feel of the market.
So it's not just like normal market ups and downs. It's the potential for really big, fast losses that could seriously hurt someone's retirement nest egg.
Precisely. And those fiduciaries, they have a legal duty, it's called a fiduciary duty, to act prudently in the best interest of the plan participants. Offering something super risky without being incredibly careful, well, that could land them in legal hot water if things go south.
Right, they're the gatekeepers for our long-term savings. Now, you also mentioned the IRS treats crypto as property. How does that play into this 401k situation?
Yeah, that's an interesting angle. The IRS classification matters. Think about physical gold bars, for example. Most 401ks don't let you hold those directly because they're classed as collectibles.
Trade in your boring job for a brilliant career using Adobe Creative Cloud. Start learning now with the free trial link in the description.
Crypto isn't physical, obviously, but it's treated as property, not currency, for tax purposes. And there's a similar kind of reluctance to allow direct ownership of assets seen as highly speculative or just difficult to manage within that standard 401k structure.
Okay, so it's a mix of the risk profile and just how these digital assets fit, or rather don't fit easily, into the existing regulatory boxes for retirement plans.
What about the practical side? Are there technical challenges too? Oh, absolutely. The plumbing of a typical 401k platform just isn't built for crypto. You need things like secure digital wallets, connections to crypto exchanges. It's a whole different infrastructure compared to trading stocks and bonds on established markets. Integrating all that is a big technical lift and a big operational headache for most plan administrators.
Okay, so direct crypto in a standard 401k sounds like a non-starter for now, mostly. But you said there might be indirect routes. How could Max or anyone get some kind of crypto exposure within their retirement savings framework?
Right. So yeah, holding actual Bitcoin or Ether directly in your regular 401k is pretty much off the table. But there are a couple workarounds, ways to get indirect exposure.
Yeah, I'm listening. How do you do that indirectly? What are the options?
Well, one way is through stocks. You could potentially invest in publicly traded companies that are heavily involved in the crypto space.
Ah, okay. not buying the coin itself, but buying shares in a company that deals with the coin. Like, what kind of companies are we talking about?
You could look at crypto mining companies, for instance, the ones with huge computer setups verifying transactions, or companies that hold a lot of crypto on their own balance sheets. MicroStrategy is probably the most famous example, holding tons of Bitcoin. Also, maybe companies developing blockchain tech or even crypto exchanges that are publicly listed.
Gotcha. But that's still indirect, right? The stock's performance isn't just tied to Bitcoin's price. It's tied to the company's overall business, management, competition, all that stuff.
Exactly. It's correlated, maybe, but not a direct investment. The company's stock price depends on a lot more than just the crypto market. So you get exposure, but it's filtered through the company's performance.
Okay, that's one route. What else? You mentioned ETFs earlier.
Yes. Bitcoin ETFs,
Yes.
exchange-traded funds. That's another potential avenue, though getting them into a 401k is still, well, it's still developing.
Right, the Bitcoin ETFs caused a big stir when they were approved.
Yeah, the approval of the spot Bitcoin ETFs in early 2024 was a pretty big deal. These funds actually hold Bitcoin, and their goal is to track its price pretty closely.
So, could Max's 401k offer one of those spot ETFs? Would that count as direct exposure?
It's closer, but access within a standard 401k is still tricky. Usually, to buy something like a spot Bitcoin ETF, your 401k needs to have something called a brokerage window.
A brokerage window, what's that?
It's like a feature some plans have that lets you invest in a much wider range of things outside the plan's main curated list of funds. But even if your plan has a brokerage window, it's still up to the plan administrator whether they'll allow you to buy Bitcoin ETFs through it. And remember that DOL guidance, that still makes administrators pretty hesitant.
Okay, so even with the new ETFs, it's not automatic access within a typical 401k. It depends heavily on the specific plan and the administrator's willingness. What about those other Bitcoin ETFs, the futures-based ones? Were they easier to get?
Some plans might have offered access to futures-based Bitcoin ETFs earlier, yeah.
Yeah.
These don't hold actual Bitcoin, though. They invest in Bitcoin futures contracts, basically bets on the future price of Bitcoin.
Didn't catch with those.
Well, because they track futures contracts, not the actual Bitcoin price directly, their performance can sometimes drift away from the spot price, due to things like contract roll costs and market complexity. So it's exposure, but maybe not a perfect mirror of Bitcoin's price.
Okay, so indirect routes.
Yeah.
Crypto-related stocks, maybe ETFs if your plan allows it through a brokerage window, but that's not guaranteed. What if someone like Max really wants to hold the actual crypto, the coins themselves, in a retirement account with tax benefits? Is there any way to do that directly?
Yes, there is. And this is where we get into the self-directed IRA or SDIRA. That's really the main vehicle right now for individuals who want to hold actual direct cryptocurrency within a tax-advantaged retirement account.
An SDIRA. So that's different from a regular IRA or a Roth IRA.
Very different in terms of investment options. Your standard IRAs, much like 401ks, usually limit you to stocks, bonds, mutual funds, ETFs, the typical stuff offered by the brokerage firm. An SDIRA, though, opens the door to a much wider world of alternative investments. Think real estate, private company shares, precious metals, and, crucially for this chat, cryptocurrency.
Okay, directly holding crypto. That
Yep.
sounds like what Max might be looking for. But how do you get crypto into an SDRA? You can't just transfer Bitcoin from your personal wallet into it, can you? Especially if the money's coming from an old 401k.
No, you generally can't contribute crypto you already own directly. The process usually involves moving cash. You need to fund the SDIRA, typically by rolling over money from an existing retirement account like that old 401k from a previous job, or maybe a traditional IRA.
Rolling over funds, okay. And there are different ways to do that rollover, right? A direct way and an indirect way.
That's correct. The direct rollover is usually the recommended path. Your old 401k provider sends the money straight to your new SDIRA custodian. The money never touches your personal bank account. It's cleaner, simpler, less risk of messing up taxes.
And the indirect way, that involves getting the money yourself first.
Yeah, the indirect rollover. Your old plan sends you a check.
Trade in your boring job for a brilliant career using Adobe Creative Cloud. Start learning now with the free trial link in the description.
Yeah. Then you have only 60 days, a strict 60-day limit to deposit that full amount into your new SDIRA. If you miss that deadline or mess it up somehow.
Problems.
Big problems. The IRS could treat the whole amount as a taxable distribution, and if you're under 59 and a half, you could get hit with a 10% early withdrawal penalty on top of the income tax. So yeah, direct rollover is definitely safer for most people moving funds to an SDIRA for crypto.
Makes sense. Stick with the direct route if possible. Now, choosing a custodian for this SDIRA, you can't just use any old IRA provider if you want to hold crypto, right?
Absolutely not. You need a specialized SDRA custodian that specifically supports cryptocurrency investments. Not all SDRA custodians do. These specialists understand the unique needs IRS reporting for crypto, and especially secure storage. They often use cold storage, keeping the assets offline to protect against hacks.
So you find one of these specialist crypto SDRA custodians, you roll over your funds directly. Then how do you actually buy the Bitcoin or whatever crypto inside the account?
You execute the trades through the custodian's platform. They'll have a system maybe integrated with an exchange where you can buy and sell the cryptocurrencies they support, all within your SDIRA account. It's not like you're buying on Coinbase and sending it over.
Right, which brings up a key point. Who actually holds the crypto keys in this SDRA setup?
That's crucial. The custodian holds the assets and controls the private keys, not you personally. You direct the investments, but they have custody. This is essential for compliance and security, and it maintains the tax advantage status. You don't get direct access to the keys like you would with a personal hardware wallet.
Okay, so SDIRA is the main direct route, using rollovers and a specialized custodian. We've covered the how. Now let's zoom out a bit. The big picture. Benefits versus risks. Why might someone want to do this, and what are the serious downsides they need to weigh?
Okay, potential benefits. The big one usually cited is diversification. The idea is that crypto prices don't always move in lockstep with stocks and bonds.
So it could potentially smooth out your overall portfolio returns. If stocks are down, maybe crypto is up, or vice versa.
That's the theory, yeah. Adding an asset with low correlation could, theoretically, improve risk-adjusted returns. Emphasis on theoretically.
And then there's the obvious one, growth potential. Crypto has seen some absolutely explosive growth phases.
True. The potential for high returns is definitely a major draw. We've seen incredible gains historically, and it's a huge but that comes with equally incredible volatility and risk. Past performance is definitely no guarantee, especially here.
And sometimes people mention it as an inflation hedge, like digital gold.
That narrative is out there, particularly for Bitcoin. Some see it as a store of value, potentially protecting against inflation like gold is supposed to. Whether it actually functions reliably that way long term, well, that's still very much debated, like gold, actually.
Okay, so diversification potential, growth potential, maybe an inflation hedge. Debatable. Now the risks, it feels like this list might be longer, or at least heavier.
The risks are definitely significant, and anyone considering this needs to stare them right in the face. Top the list. Extreme volatility. We mentioned it before, but it's huge. Prices can plummet just as fast as they can soar. Putting retirement money you depend on into something that volatile, that requires serious thought.
Yeah, losing 50% of a chunk of your retirement savings overnight would be painful, especially closer to retirement. What else?
Regulatory uncertainty is a big one. The rules are still being written globally. A crackdown, new restrictions, changes in tax treatment, any of that could massively impact crypto's value or even your ability to access it.
And cybersecurity. You have cold storage, but the whole ecosystem, hacks, scams, exchange, collapses. It's still a bit of a Wild West sometimes, isn't it?
It really is. And unlike your bank account, FDIC insured, or your regular brokerage account, SIPC insured, if your crypto gets stolen from an exchange or even potentially from a custodian in some extreme scenario, there's usually no government backstop, no insurance payout. It could just be gone.
Ouch. Okay. And then there are the practical costs, right?
Yeah.
SDRAs aren't cheap.
Generally, no. You'll likely face higher setup fees, annual account fees, and trading commissions compared to a standard IRA or 401k. Those fees eat into your returns over time, so you need to factor that in. The custodian is providing a specialized service.
And one last thing. Unlike many stocks or bonds, crypto doesn't usually pay you anything just for holding it, does it? No dividends, no interest?
That's a really important point. Most cryptocurrencies don't generate income. You're betting purely on price appreciation. Now, you can sometimes earn yield through things like staking or lending crypto, but those activities often introduce additional layers of complexity and risk within an IRA structure. It's not straightforward passive income like a dividend stock.
So a very different kind of asset compared to traditional income investments. Okay, looking crystal ball time.
Yeah.
What's the future look like? Will we eventually see crypto directly in mainstream 401k? Is this situation going to change?
It's definitely fluid. You still have the DOL being very cautious, which is a major brake on things. But you also see continued interest, debates, even some legislative proposals aiming to give people more direct control over their 401k choices, potentially including crypto.
But haven't some of the big 401k providers started dipping their toes in?
Yes, a few major players, Fidelity being a key example, have actually launched platforms allowing employers, if they choose, to offer Bitcoin as an investment option within their 401k plans, usually through separate specialized accounts.
But how many employers are actually signing up for that?
Adoption is still very low. That DOL guidance and the fiduciary liability concerns we talked about, that's making most employers hesitant to jump in right now. They're worried about the risk and the potential legal blowback.
So it feels like we're kind of stuck in this middle ground. There's demand and some infrastructure being built, but the regulatory and fiduciary hurdles are still really high for standard 401ks.
That sums it up pretty well. It's an evolving frontier.
Okay, so let's bring this all back home for Max in Duluth. And for everyone listening who's intrigued by crypto for retirement, what's the final takeaway?
I think the biggest message, echoing what professionals like Katie St. Ors would advise, is proceed with extreme caution and prioritize education. Understand what you're getting into.
So, step 1, recognize that direct crypto in your standard 401k. Probably not happening easily anytime soon for most people.
Correct. And while the SDIRA offers that direct path, remember it comes with more complexity, likely higher costs, and you shoulder much more responsibility for the significant risks involved, especially that volatility.
So, Max, if you're listening, and for anyone thinking about this,
First, educate yourself relentlessly. Learn about the tech, the specific crypto you're considering, the market risks, the scams, everything.
Second, take a really honest look at your personal risk tolerance. Can your retirement plan truly withstand the potential for sharp, sudden losses? How would that impact your future?
Absolutely critical. And third, seriously consider talking to a qualified, fee-only financial advisor who understands both retirement planning and crypto. They can help assess if it fits your specific goals, timeline, tax situation, and overall financial picture. Don't just rely on, Reddit forums.
Absolutely.
Thanks for joining us for this deep dive.
It's been a pleasure.
We'll see you next time.
See you later.
Okay, great. That's a wrap. I'm Katie St. Ors, and let me send out a huge thank you for listening. If you want more content on personal finance and small business, head over and find me on YouTube. You can also find me on Spotify, Amazon Music, TikTok, and Apple iTunes. Thanks again for tuning in, and I'll catch you on the next Deep Dive podcast.